Howdy, Jacob here. Today we're looking at Boot Barn Holdings in the specialty retail industry. 3.9 billion market cap, slightly lower enterprise value. Growth has been very impressive. 403 million in 2015 in revenue to 1.7 billion in 2024. Margins are also pretty impressive, both growing up about 3% each on the gross and operating margin side. Their return on invested capital has increased to where it's double digit, very likely above their weighted average cost of capital. So they're creating business, which is awesome. Balance sheet shows 76 million cash on hand, no short-term debt, no long-term debt. Okay. Okay. So that's a very positive sign for them. The balance sheet looks beautiful. Free cash flow, capital expenditures are growing quite a bit. They're likely, it's retail. They're putting places down, and it's causing more. They're going to have to spend more to make more, but I mean they are making more, so that's good. It's not like they're reinvesting at these terrible locations that aren't making any money. So they are increasing the free cash flow, which is awesome. And right now they're really just focused on reinvesting and then debt pay down. Um, I think it'd be interesting to see what they do when reinvestment won't encompass 100% of their free cash flow, and whether they make acquisitions, whether they buy back shares, pay a dividend. It's kind of tough to see when you don't have it. We have history here, but we don't have a history of what they do when their debt is really paid off, because we see that they just kind of like go into debt, pay it off, go into debt, pay it off. And I mean, it's been doing great for them. Everything's increasing, all positive signs, but it's going to get to a time where they're going to be more organically growing, less reinvestment, and they're just going to have to be buying back a bunch of shares, maybe paying a dividend. But I think for now, I'm ready to make some assumptions here. I don't know how much past growth is going to go into the future. They are reinvesting quite a bit, so maybe I'll say that with quite a bit of their money they reinvest, get that 6% return. It is retail, so I'm going to go market average. Retail is it's a double edged sword to me. So on one side, you can just if you have a great return on the money you get invested into the business, you can just put down more stores and like a Starbucks. I heard there was a story one time that they had a Starbucks literally a block away. This is New York City. Put a Starbucks and return on invested capital was still 30%. In 3 years, got their money back. Boom, easy money. But yeah, stores like that's the positive end. The bad end is that it is retail, so you have to go physically go into the store. And post COVID, that's been a very large decline. I mean, boots. People buy boots in Nashville when they, are like, oh, I want to live the Nashville life. Like, I don't know how many people I see in Nashville wearing boots just for fun, the natives, but still interesting to see. I think I'm fine with these assumptions right now. As for margins, they have been higher recently. They're out of debt, so I think that's fine. So maybe let's do 8 and 7% share change. Let's see if they just offset it. 13 million. I mean, they're going to have freed up cash. So I'm going to say 0%, saying that they use 10, 15, 20%. I mean, it's really just 10, 15% of free cash flow to offset stock-based compensation of no share changes. But even with those assumptions, we're saying the company's stock price needs to fall 74% to get the return to look for here. So, I mean, the numbers all look fantastic, but everything is the price you pay for it. And right now, um, I just don't think the return is going to be as great as the return that I'm looking for here. So hope you enjoy the video. Have a great rest of your day. Thanks.